Every month, you write a check to your insurance company. You call it protection. They call it inventory. In the 1980s and 1990s, America's largest corporations discovered something extraordinary. Their employees, the janitors, the cashiers, the factory floor workers, were worth more dead than alive. Not to their families, to the corporation. Companies like Walmart, Procter & Gamble, and Bank of America quietly purchased life insurance policies on hundreds of thousands of their lowest paid employees. Without their knowledge, without their consent, the employee dies. The family gets nothing. The corporation collects millions. Wall Street gave this a name. They called it dead peasant insurance. Not a metaphor, an actual industry term. And this was only the beginning.
Fast forward to today. The scheme evolved. Private equity firms, the same funds that dismantled your local hospital, gutted your pension, and flipped your neighborhood, made a new discovery. Insurance companies sit on something priceless. Permanent capital. Let me show you exactly what that means. Every month, millions of people pay their insurance premiums. That money flows into the insurance company. It sits there, locked, for decades. Because statistically, most people won't claim for 30, 40 years. This is permanent capital. A pool of money that never leaves. Now imagine, you are a private equity shark. You don't need to raise money from investors every 5 years, begging for capital. You just buy the insurance company. And now, their capital is your capital. Apollo Global Management acquired Athene Insurance. KKR absorbed Global Atlantic. Blackstone swallowed Allstate's life insurance division. In less than a decade, private equity now controls over $3 trillion of American insurance assets. Your premium, their war chest.
Now, here is where it gets dangerous. These private equity firms don't invest your premiums in boring, safe government bonds. They invest them in something called private credit. Private credit. Let's talk about what that actually means. Imagine your neighbor needs money to open a pizza shop. The bank says no, he's too risky. So he comes to you directly, and you lend him the money, but you charge him 20% interest. No bank, no regulator, no oversight. Just a private deal between you and him in the dark. That is exactly what these firms are doing with your insurance premiums. Except the pizza shop is a leveraged buyout. And the 20% interest funds an AI bubble worth trillions. The IMF flagged it in 2023. Private credit tied to insurance companies has grown from $400 billion to $1.7 trillion in under 10 years. And none of it is stress tested. No one has run the numbers on what happens when those loans go bad. When a bank collapses, the FDIC covers your deposits. When an insurance company collapses, the safety net is a patchwork of state-level guarantee funds that cap payouts at $300,000. $300,000 on a policy you paid into for 40 years.
But here is the most terrifying part of this casino. What happens when that pizza shop can't afford the 20% interest? In a normal world,
they default. The game ends. But in the shadow system, they found a loophole. Imagine you owe the bank $1,000 this month. You don't have the cash. So the bank says, don't worry, just owe us $1,200 next month, and we will count the extra $200 as profit today. You are paying your debt with more debt, and the bank is recording it as cold, hard cash. In recent months, this exact practice has exploded across Wall Street. They call it PEAK, payment in kind. Because interest rates stayed high, these private companies are suffocating. They cannot pay back the private equity firms, so they are paying them in IOUs, synthetic money. Record profits on paper, zero cash in reality. And what is the collateral backing up this imaginary money? Your real life insurance premium. But to keep this illusion alive, they needed a place to hide the paperwork. But there is one more layer, the deepest one. These private equity firms discovered that even minimal American regulation was inconvenient. So they built a trapdoor. It is called a reinsurance arrangement. Imagine you made a bet with your friend, but you don't want to be responsible if you lose. So you find a stranger in another country. No rules, no referee, and you secretly pass the bet to him. If you win, you keep the money. If you lose, it is his problem now. That stranger is a shell company registered in Bermuda, and the bet is your life insurance policy. Since 2015, over $300 billion in American insurance liabilities have been transferred to offshore affiliates operating under almost zero regulatory oversight. The NAIC, the National Association of Insurance Commissioners, published a warning in 2022. They used the phrase regulatory arbitrage, which is the polite way of saying they are deliberately hiding your money beyond the reach of the law. Remember, in our last investigation, we showed you how the technology debt bubble was being inflated. Hundreds of billions in speculative capital chasing AI valuations built on nothing. We told you someone was funding that bubble. Now you know who. It is the 73-year-old school teacher who paid her premiums every single month for 40 years, trusting that the system would protect her. Her security is their ammunition. If this system cracks, not if, when, who exactly do you think will be asked to pay for the cleanup?